Hey everybody, it's Tim Dial with Nexa Mortgage, and I just wanted to put this quick short video together to kind of go over some of the changes in the market here that have happened here recently. Over the weekend, we had this big announcement on tariffs and things like that, and so I've been getting a lot of questions and people wondering what's happening with the tariffs and how they're impacting or how they're going to impact mortgage rates and things like that. We also just had a CPI report that came out, and it was a little bit better, I think, than what some people were expecting, but it didn't really have the impact on rates that a lot of people thought because the tariffs are kind of working, or the announcement on the tariffs are kind of working against it. So I wanted to go over that kind of quickly here and what I'm kind of expecting. But anyway, over the weekend, they announced like a 90-day pause on tariffs with China, but it's not a complete pause, and I think that has a lot of people confused. So the tariff still amounts to about a 30% tariff. It's just not 100, whatever, 145% or whatever it was anymore. 145% is basically an embargo. Nobody's trading at 145%, so it stops all movement across those borders. So, but anyway, down to 30% means that there is going to be trade taking place. It's just that things are going to be more expensive than they used to be because 30% is still higher than what we used to have. So that's what this amounts to, is that trade will be happening again, but it will be at a higher cost than it used to be. It just won't be what is basically an embargo any longer. Additionally, it's only a 90-day pause, and it doesn't address the underlying issues between countries. They're still nowhere near, or not even any closer to making a real deal than they were previously. They're just pausing the tariffs because it's hurting both economies, is what it really amounts to. So anyway, so we're back down to the 30%, and then the other part of it is we're still at 10% for like all the other areas and countries, right? 10% is pretty much worldwide tariff unless you have an exemption or something, and then 30% for China. So everything's still going to be higher as a result, and so that the impact on interest rates, like when they announced this, the stock market went way up. Monday, stock market went way up because of this announcement, and then today it's been hit or miss depending on which stock market you're looking at. So it was very temporary there, and I think that temporary benefit is going to be, I think it's going to be more temporary than people realize, because this really isn't that great of news. The economy is still in a very difficult situation. We still have, we still have a lot of people who are maxed out on their credit and things like that. It's not going to increase the GDP numbers. The GDP is still going to look bad, I think, from everything that's going on in the economy and people just flat out running out of money. I've been contacting people quite a bit lately who I think are in great shape to do a refinance to help them financially, to drop their mortgage payment from, by $200 to $400 a lot of times. And what I've been finding is a lot of people who could refinance, and it makes sense to refinance, their credit scores dropped quite a bit. And that's because of what's going on in the market and how difficult things are and how much everything costs. So I don't see it, I don't see the economy being in that strong of a situation from this. I think it's still rough, and I think that these benefits that we're seeing in the economy are very temporary. I think the stock market going up is very temporary, and I think it's going to start coming back down again when people realize, tariffs are still high, prices are still high, the economy's still not in great shape, and we're heading for a recession. And I think that's going to be the realization. So very temporary. I think maybe within the next month we'll see this go back the other direction. The other part of this is when the tariffs, or when the stock market goes up like that, the mortgage rates have a tendency to go up as well. And because there's this relationship between them, people will pull money out of the mortgage bonds and put it into the stock market. That causes stock market to go up, causes mortgage bonds to go down. Mortgage bonds goes down means the rates go up. And so that's what we had happen yesterday and today a little bit. But like I said, I think it's temporary. I think we'll see the rates start to come back down again when people realize this isn't as great a news as they originally thought it would be, and it's not going to all of a sudden turn the economy around, which is what it seems like people initially were thinking or something. But anyway, I think it's going to be temporary. The rates are going to start coming back down again, but it might just take a couple of extra weeks compared to what I originally thought it was going to be. Because if this hadn't been announced over the weekend, then I think this week we would have been in great shape for refinancing for a lot of customers. Now it might take an extra week or two because this, temporary blip is going to have to go away, and it might take a week or two for that to happen. But anyway, that's kind of what we're looking at. I don't see the direction of the economy changing that drastically. I still think we're heading for a recession. First quarter was still a negative GDP number. Second quarter is going to be a low number. We don't know if it's going to be negative or not, but it certainly could be. So anyway, that's kind of where I am with things right now. I'm in a little bit of a holding pattern this week on rates, but I think that they'll turn around within the next week to 2 weeks, and we'll be back down where we want to be, and moving in the right direction again on the rates. So anyway, hang in there. And if you have any questions or want to follow up with me, I'm always here and available. So I look forward to talking to you soon. Thanks. Bye.